Hello and welcome back. We will have today a look at the other side of the coin to my last presentation. So, early half of 2023, fundraising was becoming much harder as it had been in the last couple of years. So, tough times for entrepreneurs or opportunities for new founders. Let's take a closer look. Financing or fundraising for startups is always done in staged rounds. As a startup progresses and reaches certain milestones, further funds are being raised. The reason for that is to ensure that the dilution for the founder is kept as low as possible. That means as you progress to future rounds as a founder, you are raising successive dollars at a higher and higher valuation, meaning you give up less equity per dollar raised. So far, so good. Let's have a look here at Snap. Snap will probably go down in history as one of the picture book startups. Why am I saying that? Have a look at the fundraising rounds from seed all the way to IPO. As you can see, valuations, post-money valuations of Snap over time basically went in one direction. Successive rounds were raised at higher and higher valuations. No down round. Now, fast forward to late 2022, early 2023, we had a lot of conversations on down rounds. Let's define a down round. Fundraising of a startup where the valuation of the startup has dropped below that of the previous round raised. Or, as the VCs would call it, the pre-money valuation of the current round is below the post-money valuation of the previous round raised. It may be useful to have an example on that. Imagine a founder raised $5 million in 2020 at a pre-money valuation of $10 million. Its post-money value was $15 million. Fast forward 2023, pre-money valuation of the company for this new round that needs to be raised is $8 million. Imagine we're raising $5 million again. That gives us a post-money valuation of $13 million. You see the highlighted parts where the post-money valuation in 2020 was $15 million. Pre-money valuation in 2023 is only $8 million. We have a drop of $7 million. For that loss of valuation for the VC out of the earlier round, the founder has to make the VC whole again. We call this an anti-dilution provision. Anti-dilution provisions are very common and will likely have been written into the term sheet from 2020. What does it mean for the founder in case of a down round? It means founders are being diluted twice. Number one, for the new capital raised at a lower valuation. Number two, to make the VCs from earlier rounds whole again, i.e., to bridge that gap from the higher valuation in earlier rounds to the lower valuations in the present round. So down rounds are painful for founders. Now, despite the 2022 drop, VC investments are still at historic levels. So we've seen a drop-off. Nevertheless, in 2023, we've seen significantly fewer VCs still willing to invest in startups. So life has been tough. Aside from lower valuations, VCs are just less willing to explore new investments as they are focusing on the investments for their existing portfolio companies. But we still have dry powder available. Absolutely. Plenty of dry powder to be deployed. And it remains to be seen if the second half of 2023 will see the VCs come back with a vengeance to deploy capital in those startups raising funding. Now, deployment, nevertheless, as I said before, has dropped significantly. So life is quite different for those founders that were spoiled a little bit from over the last 3 years, where fundraising was just simple. More money was chasing the existing opportunities to invest in good founders. What are the implications for entrepreneurs? Number one, we need to get used to down rounds. Achieving the same valuations as we saw in 2020 and 2022 will be unlikely. Or, as a VC recently said to me, flat is the new up. What he meant was, if you manage to raise money again at the same valuation as in your previous round, well done. Secondly, extend your runway. Make your dollars last longer. So be cautious about spending, be cautious about new hiring, and obviously the use of venture debt, bridge round, convertible notes, and overall structured deals has become a lot more common. Overall, the pitching or fundraising environment has moved from growth at all cost to questions around path to profitability. So investors want to hear about your plans on how you will move your company from your present stage of negative cash flow to potentially a profit in the near future. Obviously, a heightened focus on unit economics is no surprise. Some investors are bargain hunting, nevertheless, and I should add that to it. So there will be the opportunities for those founders that are willing to take a slightly lower valuation than in the rounds before. Thank you very much, and I'll see you again for our next round of conversations around venture capital and private equity. Thanks for joining me.